All right. Good morning. Welcome back here to Trader Minute. Great to have you aboard. Jam-packed data morning here this morning. So let's get into it. Let's take a look at what's going on here. A lot of news, and we've talked about it. There's a ton of turmoil around the world, and different things that could happen, and different things can transpire in all of these events. We are seeing the markets, react to a lot of that. This morning it's about data, and in fact, you can see the S&P futures last night drifted on lower towards the lows from yesterday. Then we saw this fall off right here about 6:30 a.m. my time, 8:30 Eastern. And this happened on retail sales data. And the retail sales data was significantly better than expected. And that caused the market to push on down. Okay. Now, you can see this rebound that we've had in the last, 10, 15 minutes. What's going on? Well, we had home builder data that's negative. All right. And so we have some positive economic data, market sells off. We have some negative economic data, and the market rebounds. And it really just has to do with bonds and the perception when it comes to bonds. If we pull up the TLT, you can see, the data that we had on retail sales caused bonds to go down and rates to go up, but they haven't recovered in the same way here on this home builder data, even though the market itself, has. We are seeing relative NASDAQ weakness here today. Sectors like banks, energy, they're all higher, while the NASDAQ is lower today. Healthcare doing okay, but consumer staples are up, materials are up here today. Yet, the market indexes are down. So what gives? What's going on? Let's go take a look at a few things here and transition over to the screen. You can see here the two kind of major headlines. U.S. retail sales much stronger than expected, which we talked about, and then U.S. home builder sentiment weakens for the third month. And you can see what's going on with U.S. home builder sentiment over the last 4 months. We hit a high here in July, and it's slowly been eroding here since, which is what the Fed wants and what the Fed has talked about needing. So the market does look at that as a positive. Okay. Now, overall with bonds, one of the things that we need to understand when it comes to all these economics and all this data, we've had a ton of data over the last couple of weeks, but you can see bonds, they really haven't gone anywhere since this big drop here in September. Here in October, they're slightly lower, but they've really been contained in this level, and it's an important area. And the lows here for October are important to hold. And there are some fears that if bonds do break this level, that it will be a runaway train down, which will be a runaway train up for rates, and have some negative implications overall for the markets. If we do see bonds bottom right here, could have some positive implications, especially for consumer staple stocks. These stocks have been really beaten down on the move in bonds. And it's one where you can see bonds are near lows. Consumer staples are showing some relative outperformance here over the last couple of weeks. It tells you, maybe there's some bottoms in some of these. The McDonald's of the world are trying to bottom out. We already saw Pepsi earnings. Are they trying to bottom out here? I don't think there's enough evidence to say, yes, the bottom is in. But the start of the bottoming process is, definitely, going on and happening. Now, along with all this, we've had some earnings. We had J&J earnings here this morning, Johnson & Johnson, and they initially traded up and then down. and all around here. You can see overall, you can't really tell that they have earnings here today unless you own the options. And then you see both the calls and the puts going down, and you're like, yeah, trading earnings, options on earnings. Bank of America, can't even tell it had earnings here today, can you? Very flat reaction here. And if we come into Estimize and just take a look here at Bank of America's earnings, and I haven't broken them all down yet, gone through my normal process with them yet, but if we just look at the raw numbers here, maybe they want me to verify that I'm human. There we go. All right. You can see that very similar to JP Morgan and Wells Fargo, Citigroup, what we saw last week, they beat on earnings, right? And on revenue here with, they were a little bit different as they only beat minimally. It was a very, very small beat here for Bank of America. But when you look at revenue going forward, -1, -4, 0, 0 in terms of the growth categories for the next 4 quarters. If we look at earnings per share, -16, -17, -6, -10. So yeah, they beat, but is there really anything to get excited about with a company that has negative revenue, negative earnings expected for the course of the next year? No, there's not. So, I look at this the same way I look at JP Morgan, as Citigroup. Okay, yeah, it was a relief to see the numbers not all that bad, but there's not a huge, massive improvement in the numbers going forward that warrants a big move or for investors to move aggressively into these names. And that is that's the reality of of the earnings here for these companies. If we come into J&J, Johnson & Johnson here, and just take a look at the the raw numbers here. Sorry, it's wanting me to verify I'm human again. Here we go. Human. Incorrect. Okay, let's try that again. All right. Sometimes these puzzles, it's like, okay, I don't know where the end is. All right. It's not giving me one that I can actually solve. Let's see here. There we go. All right. So here we go with J&J. You can see they beat on earnings, right? They beat on earnings. And on revenue, they also beat. They came in above Wall Street expectations. But going forward, -11% on revenue, -15, -13. It's just nothing to get excited about. So yes, they beat. But even on the earnings standpoint, 9% growth next quarter, but then -2, -3. It's not something to get excited about with these companies. This is not where the earnings and revenue growth are in the market. And so, yes, relief in terms of, hey, they aren't falling off a cliff, sure, but any sort of significant confidence about things going forward, no, there's not much there to get excited about, okay? All right, so that's the landscape we're looking at this morning. And again, we have, earnings season really ramping up this week. Tomorrow, we will get some housing starts numbers in terms of economic data, but earnings will have Netflix and Tesla and Morgan Stanley and some more as earnings season kicks off. Now, to go with this economic data and this earnings and everything else, there was some big news for NVIDIA. And in terms of China and chips and U.S. sanctions and how NVIDIA chips or what NVIDIA chips can and cannot be shipped to China. So it has caused NVIDIA to drop. And when we look at how big of a market cap NVIDIA is, we know that this has a strong weighting here on the indexes, okay? So if you look at NVIDIA, you see it down big. You look at the chips, all the chips are down, or most of the chips are down pretty big. Well, this has much bigger weight on the market than the entire energy sector or the entire healthcare sector. You combine that with the negative Apple news, we have some very big weight dragging the market down here today and causing the indexes to look uglier than what they are if we look at the number of stocks advancing versus declining. Because here today, despite the indexes being down, we have more stocks that are green than we have red. And yeah, that's just the nature of what this market is anymore. But Nvidia, Apple really kind of dragging down the indexes here, despite some relative strength out there. And there is, take a look at small caps today. They're up 1%. There's some real relative strength in some nice pockets out there. You look at materials, you look at energy, you look at, even healthcare, which is down, but holding up really well. You look at industrials, they're green. You look here at consumer staples, they're finally green. Utilities, they're slightly red, but nowhere near kind of the sell-off that, when you look at some of the headlines out there that's being perpetrated, it's really, the tech sector here being dragged down by these chips and by Apple. Now, speaking of the tech sector, for the challenge, we got into a new trade yesterday, CRM, Salesforce. And I don't know that we've gotten into a single trade this challenge that hasn't gapped down the next day on some sort of news. I swear it's been crazy. Even Meta, we gapped down like $4 the day after we got in. And CRM, no exception. Gap down 250 this morning. It's now trading higher here, up 85 cents. So, similar to what our entry price was yesterday. Not going anywhere on that. We do have cash for another position, and so we'll look for some trade setups with that. There was nothing that I was too excited about. I looked at things like Qualcomm, that triggered bearish the other day, but just haven't had a good entry point here for it. Same with the Home Builder Index, just not a good entry point, for that. So haven't gone into those. And then some of the bullish signals that we saw yesterday. It's like Las Vegas Sands, okay. This was a bearish 2 days ago, but they have earnings this week. And we saw that with some of the bullish signals from yesterday. So I'm not going to consider those with earnings, right here at around the corner. So holding on to CRM, that's some of the update on some of the stuff that's going on here this morning. We'll see how the market digests all that here in the next few hours. And if we have a trade signal here this afternoon, we'll look to go and take it and get into something else. Thanks for hopping on. Have yourselves a fantastic day, and we will talk to you later. Take care.